As a bit of an investing nerd, I'm always on the lookout to try and find the best things to invest in. And one of the most important things to consider when you invest is always going to be fees. So I've done a bit of digging and I found some of the cheapest funds that you can invest in. And it's possible that if you choose the right ones, you could end up saving yourself tens of thousands of pounds across your investing lives. However, just before we all go changing what we invest in just based on costs alone, we've got to see what's the catch. After all, surely if you pay a little bit more in fees, then you have to get something in return, right? Well, let's just have a look and see if the devil is in the detail. Now, as many of you already know, I speak a lot about Vanguard funds on this channel as they're one of the biggest names in the investing world. And with that big name comes decades of experience, security and trust, which are all good things when it comes to investing your hard-earned money. But sometimes it's easy to forget that there are loads of other providers out there, and we might be better off if we switch around and be a bit more frugal. After all, there's no benefit to being a loyal customer here. It's not like you suddenly make more money than someone else who invests in the same fund. So, step one, let me just explain and show you what I'm looking for and how I found these funds. The criteria I want pretty much comes down to the basic foundations of investing. I want a fund that's well diversified, which means owning a huge number of companies across a wide variety of industries and who work all over the world. This part is so important because investing in just one company, one industry, or just one country can bring with it loads of risks if the past has taught us anything. Secondly, I want it to be passive. So by that, I mean that all I want the fund to do is to track an index without any active managers at all. I don't want to pay for an active manager to tinker with anything. I'd rather we keep the costs low and pass those on to us investors. After all, fund managers and active money managers have a terrible long-term record, but that's a whole other video and I've covered that topic many times before. Then I want to make sure that it's a big enough fund that's got a bit of history. Remember that if you want to buy any kind of investment, especially an ETF, you also need someone else to sell you that to make that investment. Likewise, on the way out, if you want to sell your shares, you will need someone else to buy them from you. So it goes without saying that we need to make sure that the fund has enough money and liquidity to cover that. Otherwise, you could end up with all of those gains but not be able to get out. And finally, I want it to be cheap, but that's pretty obvious that that's what the video about, so let's get searching. So to help with my research, I'm going to use this very useful website that I like to browse on now and then called Just ETF. The clue is in the name, but you can pretty much search for all kinds of ETFs on this website and get loads of information like how many stocks a fund has, how much it costs to invest in, and how much money is invested inside of the fund. You can search by all kinds of category, but for this video, I want to keep things pretty wide, so I want to filter these funds and see what I can get if I choose global. So I'll choose the world, and then that leaves me with 365 funds. Now, I think it's pretty easy if I just filter these straight away by the lowest cost and then see what we're left with. And I do this by choosing this column here called TER, as this stands for Total Expense Ratio. Basically, this is the amount of money that you will be charged per year for investing into the fund. And remember that it's a cost that's built in, so you don't see it coming out of your account or pay it separately. Now, we're already seeing some very low costs here, 0.05%, and that is probably some of the lowest fees you'll ever see as a UK investor. So what's the catch? Well, let's have a look and see. So right off the bat, there's two versions you can see here, an accumulating version and a distributing version. All that means is that one fund will pay you dividends out to you as cash, and the other ones will take those dividends and reinvest them without you ever seeing them or hitting your account. Now, over the long run, if you invested the dividends back in for yourself, the performance would be exactly the same, assuming that you aren't hit with any additional cost to invest. Okay, so a couple of big things stand out here for me. It's a global fund with more than 1,400 companies inside of it, so a big tick there from a diversification standpoint. It's obviously low cost, as we just said, and it's also a passive fund that tracks an index called the Selective GBS Developed Markets Large and Mid Cap Index. Now, to find out a bit more about that index, you'd have to look into it, and you can find a fact sheet that describes what it's trying to actually do. I assume here that one of the reasons their fees are quite low here is that Selective probably charged them quite a low fee to license their index. You see, anytime you see index providers like FTSE or S&P in the name of an ETF, you know that this provider is having to pay a small fee in order to use that name in their index. You would all be familiar with S&P and FTSE and others like MSCI, but Selective is a much smaller provider that I'd not really come across before. Doesn't make it a good or a bad thing, it's just worth knowing about. Now, another thing I can see is it only invests in developed countries. So although this is classed as a global fund, you're not going to get any emerging markets here. Again, whether that's a good thing or a bad thing for the future, who knows? I have no idea where the future growth is going to come from, and neither does anyone else. So if you leave out emerging markets, is that worth the lower fees? That's something for you to decide as an investor. Another thing worth looking at is fund size. I can see that it has almost £300 million worth invested inside of it. Plenty for the average investor, but clearly not for people with billions. Finally, worth noting here that the fund is priced in US dollars. Now, this isn't normally a big issue, as any fund that we buy in the UK is going to get hit with exchange rates at some point. After all, if you want to own some of the biggest companies in the world, you're going to need to buy them in all US dollars. But you will have to factor in a small fee to buy into a fund like this, as if I do have a look here and try and find this on my Trading 212 account, I can see that this fund, which you can find with a ticker symbol PRWU, is traded in USD, as you can see. Now, this means that if you did buy the fund on here, you'd have the FX fee to pay. Now, luckily on Trading 212, it's about as low cost as you can get, but it is worth knowing about. Now, other funds with a similar market, for example, the Vanguard Developed World Fund, is available to buy in pounds, even though the fund itself actually has a currency of US dollars. Why this is the case, I'm not 100% sure, but I did just want to highlight it and make you aware. Always check what currency you're buying this fund in, and you can do this by searching pretty quickly and easily. Okay, what about some other options? Well, coming in close second based on price is this Legal & General Global Equity Fund, and this has the ticker symbol LGGG. Again, I'll just pull this up on Trading 212 to make sure it's available. Worth saying that if you do want to open an account with Trading 212, I keep the link in the description, and new customers can get a free share for signing up worth up to £100. Now, they offer a free stocks and shares ISA, and I have one of my own accounts here as well. Remember that you can actually open as many stocks and shares ISA accounts now as you like, so you can give them a try if you want, and if you don't need to stick with it, you can just forget about it. Now, the cost for this fund is 0.1%, which is still very cheap, but then that's double the cost of the Amundi one. Having a quick look, it also follows another selective index, and this is just in developed countries, large and medium companies. It's got just over 1,250 companies inside of it, and has over £100 million invested. Just for reference, if you take one of the most popular global funds from Vanguard, which you can find by searching VWRP or VWRL, these have a cost of 0.22% a year. Again, still not something that I'd consider expensive, but when you compare it to the other fees, it's almost double. Is it worth paying more for the emerging markets? That's a big question you have to ask yourself as investors. Remember, it's your decision, and I'm not a financial advisor, nor do I ever claim to be one, so please do what's right for you. Now, rather than just bore you and go through a list of funds, which you can just do yourself, let me just put into perspective what these costs mean over a very long investing time horizon. For example, let's say that you could invest £300 a month, and you do this for 30 years. If you manage to get an average of 10%, just to make this nice simple calculation, you end up with £624,000. Now, what if your costs were a tiny bit higher? What would that actually do over 30 years? Now, let me show you now. So to work this out, let's just say that we're going to invest in a fund that only has a 0.05 expense ratio compared to a 0.22% one. Now, the difference between the two numbers is 17 basis points. So if I run the same example and give you a return of 10% minus 17 basis points every year, here is what you actually end up with. The number is £604,000. So £20,000 across 30 years if you can reduce your fees from 0.22% to 0.05%, assuming that they both perform the same. Now, that's nothing at all to be sniffed at. In fact, if you work that out on a monthly basis, take 30 years worth of months, so that's 360 months in total, and divide that by £20,000, that's £55 a month that you're paying in fees if you take the more expensive fund. It's pretty crazy, isn't it? And that's because every year, rather than getting 10% of compound interest, you're only getting 9.83%. And that really does add up over the years. I'll be honest, I forgot just how much difference some of these small numbers can make. So I really hope that this makes you think twice before you invest in expensive funds or expensive accounts. Can you imagine what this looks like if you pay 1 or 2% a year for an advisor? And we'll leave that topic for another day. Anyway, that's a few good options of funds that cover most of the world, but what if you truly want a global option? Well, you need to pay a bit more than 0.05%, but it is cheaper than some of the more popular funds that I often refer to. The one that stands out for me here is this one from Invesco. It's the Invesco FTSE All World ETF, and it comes in two options for you, with dividends and without. If I grab the one that accumulates, as this would be my preference anyway, as someone who just wants to set and forget and have everything taken care of, I'll see that it trades under FWRG. Again, just a quick search on Trading 212 just to make sure that it's there, and I can see that it does indeed appear. I think that this fund is the cheapest ETF that tracks the FTSE All World Index at just 0.15% expense ratio. And the Vanguard equivalent is charged at 0.22%, so that is quite a large 7 basis point for effectively the exact same thing. I guess the biggest question though is, like I said before, it really depends what you want and need, and whether or not you think the extra costs are worth it for you. Now, personally for me, I don't chase all of my investments just based on price alone, but there is a major factor that I look at. I think I prefer to own the world and not just a developed world, but then who knows if that could turn out to be a good decision or not if we fast forward over the next 10 or 20 years or so. Ultimately, you need to invest in something that you can stick with for the long run, you're going to commit to, and you're going to feel secure with. As with anything in life, I think you should try and look for the good value and not just price, as those are two very different things. Another thing worth asking is, well, why don't we just go along with the S&P 500? Isn't that the index that everyone talks about, including me on this channel? Isn't this the best index that everyone tries to beat? And the answer would be yes, you could definitely just go along with the S&P 500 if you want and not bother going for global stocks outside of the US. Now, I did a video on this topic a while back looking at the S&P 500 versus the world, and I think that covers a lot of the points, but the short answer would be that it really just depends on what you want and where you want to place your bets. Now, I like to invest globally just to make sure that I don't miss any growth that might happen outside of the US. However, if you only want to bet on the S&P 500, then you get some extremely cheap options. In fact, if I just quickly filter out funds that only invest in the S&P 500 on the Just ETF website, then you get options as cheap as 0.03% from these ones here. This is quite funny as it makes Vanguard's really popular VUSA fund look quite expensive, even though it only costs 0.07% a year. Now, I'm not going to look into any more detail here, I'll leave that up to you, but I do hope that you found that useful and that you can continue to use kind of tools like this and other ones to do your own research. Anyway, I'd love to get your opinions in the comment section on this one and let me know kind of what you think about fees and how you approach your investing. Also, let me know, do you want me to make a video where I try and put together a multiple ETF portfolio with the absolute lowest cost possible? Maybe that could be quite an exciting challenge, and try and use every fund without using Vanguard. Could be quite a bit of fun. Anyway, thanks as always, and happy investing.